Good day, everybody. Today we're going to get into Chapter 7, which is titled Financial Management. So obviously, as we've been talking about throughout the course, we have a couple of different sources for cash. We've got ourself and we've got someone else. And we got to decide when we're going to use our money and when we're going to use somebody else's money and what goes into that. So first off, we're going to talk about your money. We're going to talk about the cash, what you have. So we'll talk about your cash flows and what we can use to manage our cash. So obviously have our checking accounts that we can use for our cash management, our basic checking accounts. Money goes in, money goes out to pay all of our bills. We've got our checks, we've got debit cards, we've got automatic payments that we may have that's determining everything that's happening within our checking account. It's a good thing to reconcile that compared to our records to make sure, well, A, to keep the bank honest, because they do a good job, but they're not 100% perfect. So we've got to make sure, and then also to just be on top of knowing what we have. If you're not keeping track of your account, you could make a mistake and then get overdrawn because you spend money you think you have, but you don't necessarily have. So we've also got ways that we can save. So we're going to talk about the markets or institutions that we can use for save, compare and contrast the different ways we have. So for savings accounts, we're looking at, you've got your basic saving account from the bank. But obviously, if you've ever seen the rates on those, not great. Interest is relatively cheap these days. The interest that the bank is going to give you isn't much. So it's a perfectly safe, it's insured up to $250,000, but you have, you're not getting much out of it. Your money's just there. And then it's also very liquid. You can take it out when you need it. Other options that we have, or if you're looking at investing in the money markets or the capital markets. So money markets are more short-term. You're going to get a little more interest than maybe necessarily the local bank. And you're going to have that liquidity. Capital markets, you're not going to quite have as much liquidity. It's going to be for more long-term investing, but you're going to get a little more return out of your money. So if you're saving for a long-term goal, saving up for your education, saving up for your retirement, you're going to use the capital markets. You're going to be invested in funds that are trading stocks, that are investing in stocks and keeping your money there. So as far as our savings institutions, what most of us have experience with are going to be your local retail banks or credit unions. So those are the ones that are going to be managing your money, handling your checking or savings accounts. And they're there for the consumers or their members for their saving and their borrowing. So that's also who we're going to go to when we need to obtain funds for our purchases, which we'll talk about in a little bit. Looking at big business things, you're looking at the commercial banks or the investment banks as far as handling the cash flow for those entities, helping them with going public, providing large million-dollar loans for business financing. So like I said before, we've got our checkings, our savings. You can also have a CD from the bank. That's all going to be low-risk stuff, but you're not going to get a lot of interest out of it. The things with CDs, you'll gain a little more interest than you will with your typical savings account, but you're going to lose the liquidity without paying a penalty. If you take out of your CD early, they're going to charge you a penalty. So it depends upon how soon do you need your cash. What are your liquidity needs? If you've got some extra funds that you don't think you're going to need for a while, then you can put it in to some of these savings items. But if you need relative liquidity, you need access to your cash, then just keeping in your checkbook or your savings account is going to be the best option for you. So of course we go to the bank and we've got all those different ways that we can use the bank. And depending upon where you're located, you're going to be using your credit union or your retail institutions for your savings, for your checking, for your short-term loans. But hopefully we can at least use our money in some way to gain some sort of return, even if it is from our savings account or checking account. So now on the other side, what if we're not revolving on ourselves for the money? Then we have to go somewhere else to obtain the money. So we're going to talk about credit and a bunch of different factors going into credit, going into a credit card. So credit basically means you get to pay later. So somebody's offering you the opportunity to pay for something in installments so that you don't have to have the money all at once. Or how would we obtain, the major assets in society? Being able to buy a house. We're going to have a difficult time having $100,000, $200,000, $300,000 to put down on a house. So if we're borrowing on credit, we're financing smaller expenses. It's relatively short term. You do business with anybody, they hand you a bill and you pay them later. You're doing things on credit. They're granting you credit, the ability to pay later. Paying the doctor after the visit. Paying your mechanic after they give you an oil change. Et cetera, et cetera. Whereas if we're going into debt, we're using debt to finance assets, those long-term assets, financing a vehicle purchase, financing a home. We could have installment credit or revolving credit. Installment credit, we're going to be getting that credit from one vendor, from one person we're doing business with for a specific purchase. Whereas revolving credit, we can charge many different things against that. That would be an example of a credit card that we can go use at many various different businesses, and that bank that's financing credit, the credit is going to pay the vendor, and then we owe the credit card company or the bank, whoever is offering that. So if we're doing it on an installment, we make arrangements with that specific vendor. When's it going to be that we're going to pay this over with a card? We're going to get our statement in the mail, and we've got our choice. Do we pay it in full or do we carry a balance? Obviously, it's in your best interest to pay it in full and not get stuck with the interest charge, because credit card interest can be significant. Generally anywhere from 12, 14, 16% up to as high as 30, 32%. I was in a store the other day and I saw an ad for their store credit card, and gosh, I think it was, I can't remember, 28 or 32%, some ridiculous number. And I mean, if you get trapped in that debt, oofta, it can be difficult to get out. How do we obtain credit? Well, a lot of things, companies, either our vendors or the banks, they're going to look at our credit score. So your credit score is essentially ranking you and your debt-paying ability. So there's 5 different things that are going to go into determining your credit score. And depending upon the company that's doing the credit score, you're going to get ranked from anywhere for a score from 300 to 900. Obviously, the higher it is, the better you are, the easier time you're going to have getting more credit. Deciding to go get a loan to buy a car. You have a good credit score, not going to be too hard of a process. They'll hand you the key over today. But they're going to look at your payment history. How well do you pay your bills? How well do you pay your bills on time? So if you've got a long history of paying off everything month after month after month, you're going to score well here. If things lapse and things don't get paid, that's going to affect. They're going to look at how long is your credit history. How long have you showed the ability to pay those debts off? Obviously, if you guys are younger, you may not have a lot of debt. You may not have much of a credit history. If you haven't had bills in your name, if you haven't loans in your name, if you haven't had a credit card in your name, a cell phone, if a lot of that stuff's still under your parents, it's going to take time to build up that credit history, to get somebody to trust you to give you debt. How much debt do you currently have? And this would be all different types of debt: credit card debt, student loan debt, mortgage debt, whatever. What is every dime that you owe to basically somebody that's available for these credit sourcing agencies to find out about? And then what types of credit have you received in the past? And how much new credit? How many credit cards have you opened up in the last 2 or 3 years? They're going to look at stuff like that. Obviously, the more you've done that, you may have difficulty obtaining other forms of credit, the more you have out there. So there's a bunch of different websites that you can use to determine what your credit score is. A lot of credit card companies now in the last year have started, they've got an option that when you log into your credit card account, you should be able to find out your credit score. So if it's through that option, or if you go to one of these websites, you should be able to obtain your credit score. By law, you're able to get it for free once a year. You may want to watch Experian, because they're the ones that had the breach last year that, I believe was this? No, it was Equifax. Equifax, I believe, had the breach. So maybe check out one of the other websites. Okay, what about a credit card? So we obtain credit. We can get a credit card from our bank. We can get a credit card from Visa, Discover, American Express, Capital One, whoever. There's many different companies, or as I was mentioned before, many different vendors that have their own store credit card. Walmart, Target, Shopko, Best Buy, etc. So some features of your credit card are going to be your credit limit. What's the maximum amount you can borrow from them? What's the maximum amount you can charge on the card? What's the grace period? When you got to pay? Generally monthly. What guarantees that it has with it as far as what you can purchase, different liabilities, things, depending upon if it ends up into somebody else's hands and they make charges in your name. Something you got to factor in this day and age. And a lot of credit cards will sucker you in by what rewards they offer, whether it be miles for airline or cash back or whatever. Dave Ramsey's got a good line. I've never met a millionaire that said he got there based on his credit card points. So what fees are going to go along with our credit card? Well, we're going to have our interest rate. So what is that rate that they're charging you? Does that rate change as your balance goes up or your balance gets older? What's the late fee if you miss a payment? What's the fee if you use your credit card to get cash? What's the fee if you transfer a balance from another credit card? Is there an annual fee? Now, this has went away with a lot of different credit card companies, but there's still some that they'll charge you $100, $200 a year just for the right to have that card. Please don't go and do that if you do decide to use credit. So obviously, it's easy to get into trouble with credit. It's easy to swipe that card and then fall behind and let that interest continue to pile up on a large balance. So please use your debt, use credit cards in moderation. Do your best to pay off that bill or make significant progress towards paying it off. If you get into trouble, you can look at consolidation. You can look at debt management and some different tools to try to dig yourself out of the hole. You can talk to the credit card companies and try to adjust the terms, maybe even get some of it forgiven. These are worst case scenario options. And worst comes to worst, you may have to file for bankruptcy. And then there's just a bunch of different laws to protect you against these big companies that are offering you credit. So it is a short-term financing option. Don't get reliant on it. It can be expensive depending upon the interest rate and whether you allow that balance to build up on your credit card. Pay attention to the different features of your credit card. Pay attention to the extra fees. And then you can try to renegotiate, consolidate, or whatever if you do have issues with that debt. And there are laws out there to protect you. So if you're going to go to the bank and ask for a loan, well, that bank's taken on some risk. Of course, there's default risk. What's the risk that they're not going to get paid? I've got a banker that I know that I bring into class sometimes. He says, the first thing I think about is when am I going to get paid? The second thing I think about is when am I going to get paid? So obviously, this is most important to the bank, that they are handing you this money and they trust that you are going to pay it back. So they're going to factor in what's called interest rate risk. So basically, depending upon your credit history, depending upon a few different factors that we'll talk about in a second, does the risk of them not getting paid, is that lessened then to what they're going to make in interest off of you, so that they make a profit off of this? So like I said, your default risk is going to go into your credit score, and then the banker is going to look at what's called the 5 C's of credit. And those 5 C's are conditions, character, collateral, capacity, and capital. So character is trying to predict your ability to pay it back. How much of you are an honest citizen that pays your debts? You know, and part of that is looking at the credit score then. The credit score shows your history. Have you shown that you take out loans and you pay them? So they're going to want to see that. Month after month after month, you're going to pay that when it's due. So capacity, can you pay it? So they're going to look at your tax returns. They're going to look at your W-2s. Do you have the ability to pay back this money? They're going to take into account collateral. So what are you buying with this loan can act as collateral. That can be mortgaged to the loan so that if you don't pay it, they get the asset. Or what other assets do you have that essentially can act as backup just in case you don't pay? So capital looks at, like we've talked about before, what's your net worth? What's your wealth? What do you have? What do you have in assets? What do you have in savings? So that if your income drops off, can you still make the payment? And then conditions would be looking at what they expect to happen into the economy, goes into part of the interest rate risk and deciding what kind of rate they're going to charge you. So as far as interest rate risk, you got to be aware of, hopefully they won't have a penalty for you paying early. It's possible that you could get a floating rate loan. So the rate is not set. The rate is possible that it could change from year to year depending upon what's going on in the market, what's going on in the economy. As the Federal Reserve sets interest rates and what banks can borrow from them at, as that rate rises, the amount that they expect you to then pay would rise in such a scenario. Now the prime rate is what rate that the banks provide their very best customers. So when there's very little risk on their part to get paid, and you can see over time there's been a large change in that prime rate. So if you look in the 70s, getting up to around and over 20%. Buying a house at 20-some% interest, very difficult 30 years ago, 40 years ago. You can see that rate has steadily declined down to now when it's been fairly low, and you see fairly flat for about the last 5-6 years. Now, in the last year, we've kind of seen, the start that the economy's been good for a few years. Interest rates are going to start to go back up here a little bit in the future, which could have an effect on then you getting those loans for mortgages or what you're going to end up paying on those mortgages in the future for you guys that are younger and don't have a house yet. So they're going to factor in what's the prime rate, what's your interest rate risk. And those are going to come together. So how risky are you as a customer? And then that's going to get the total rate that you're going to pay. So if we're using credit, we're going to pay high rates for short-term things. If we're using debt, we're financing long-term assets. It's going to be more difficult to be approved. It's a more lengthy process to go through and get a mortgage than it is to get a store credit card, which they'll basically hand to you on the spot. So you can use debt as a tool to create wealth. You can use debt to get assets, obtain a business, obtain land, obtain a house, where you can build wealth for yourself. But when those more short-term things, you're using charge cards, then you can get into trouble. So what interest you're going to pay on those debts are determined by how risky the credit company thinks you are. Please use your debt to finance assets, things that are going to build your wealth, not those recurring expenses, those short-term things that you're now making much more expensive by paying 20% on top of. So that's our chapter on cash and credit. You know, one thing I want you to do is analyze your credit spending capacity, how you generally use credit, and look at ourselves if there's any way we can improve there. I want you to be able to get your credit score using one of those websites and see how you stack up, and then how can you improve that for the future as you want to go in and take out debt for some of these asset purchases in the future for any of the goals that you've talked about prior in the semester that you want to obtain for yourself.